Hi viewers, in this video we are going to discuss about the further aspects of the marginal costing. So first, we are going to discuss about the what is contribution, what is profit volume ratio, what is margin of safety, what is break even point, what are limiting factors. So in addition to that, we are going to discuss about certain formulas applicable for marginal costing. Now, let us start with the meaning contribution. What do you understand by the term contribution? So here, generally, there is a formula for contribution. So, standard formula for contribution is contribution is equal to sales minus variable cost. Contribution is equal to sales minus variable cost. Here, it refers to the excess of sales over the variable cost. Supposing the sale is 5 lakhs, variable cost is only 3 lakhs. So, contribution. Two lakhs. Fine. This is the standard formula for contribution. There are more formulas for contribution. So this is the basic formula for contribution. And then contribution is not the final profit. Please make a note. Second point. Contribution is not the final profit. It is just the marginal profit. Marginal means additional profit. So here contribution means so uh, it is not the final profit, it is just the marginal profit. So here, your variable cost is, I am coming to this example, your variable cost is only 3 lakhs, but you have sold for 5 lakhs rupees. So you have manufactured the goods for 3 lakhs rupees, whereas you have sold the goods for 5 lakhs rupees. So that 2 lakhs is the margin rate. That is what? It is called as marginal profit. So here you are contributing 2 lakhs to the business. So here you have incurred 3 lakhs for manufacturing the goods. Okay. And then you have sold that particular goods for 5 lakhs rupees. So the remaining 2 lakhs is staying in your hand. So that you are contributing 2 lakhs to the business. So that is what is called as contribution. Okay. So contribution covers fixed cost and profit. So another formula for the contribution here is fixed cost plus profit. Another formula for contribution is fixed cost plus profit is also called as contribution. So if the contribution is more than the fixed cost, there is a profit. So if the contribution is less than the fixed cost, there is a loss. Okay. Say for example, fixed cost plus profit is equal to contribution. So let the fixed cost be 5 lakhs. Let the profit be 2 lakhs. Contribution, fixed cost plus profit is equal to contribution. 5 lakhs plus 2 lakhs is equal to 7 lakhs. If the contribution is more than the fixed cost, here contribution is 7 lakhs, whereas the fixed cost is only 5 lakhs. So here the contribution is more than the fixed cost. So there is a profit. Suppose if contribution is lesser than the fixed cost, Suppose the contribution is 5 lakhs. Fixed cost is 7 lakhs. Assume that the contribution is 5 lakhs. So fixed cost is 7 lakhs. So if the contribution is lesser than the fixed cost means then there is a loss. Okay. Please take a screenshot of this. Now shall we move on to the next? Profit volume ratio. Profit volume ratio. So it is shortly referred as, it is acronymed as PV ratio. P stands for profit, V stands for volume of production. So here, profit volume ratio is the technique of three components are available: cost, volume, profit. So profit volume ratio. Three components are available: cost, volume, profit. So cost means how much cost that you have incurred for manufacturing the goods. Volume means volume of production, how many outputs that you have produced. And then profit. So by comprising of the cost incurred for producing number of outputs, by cost incurred for this much cost incurred for producing number of outputs. So how much you have sold. So that is what is the profit. So that margin is what is called as profit. So that is what is called as profit volume ratio. So it is the profit volume ratio means contribution to sales. Okay. PV ratio formula. This is the standard formula for PV ratio. Contribution divided by sales into 100. Okay, that is what is called as contribution to sales. So out of sales, out of these many products that you have sold, out of for this much amount that you have sold the product, how much is the contribution? How much percentage is the contribution? That is what is called as PV ratio. PV ratio is measured only in terms of percentage. So how much you have sold. So for which how much you have made the contribution. So that only measures the PV ratio. Okay, so PV ratio is measured in terms of percentage. Okay, it shows the relationship between contribution and sale. Okay, P stands for profit and V stands for volume of sales. Okay, again I am giving you the clarity. So how much you have sold? Say for example, if you have sold for 10 lakhs rupees. For 10 lakhs rupees, how much contribution that you have made? Suppose if you have made contribution for 4 lakh 50,000 rupees. In such a situation, PV ratio is 45%. Understood? This is all about the profit volume ratio. Please take a screenshot of this. We move on to the next. Now, break-even point. So, break-even point, in short, what do you mean by break-even point? Break-even point means in short, no profit, no loss. So break-even point is the point where sales revenue equals the cost to make and sell the products when no profit, no loss is reported. Break-even point where a point where sales revenue and cost will be equal. The point where the sales revenue and cost will be equal, That particular point is called as break-even point. A break-even point is the point where there is neither the profit nor the loss. No profit, no loss. That is what is called as break-even point. Okay. Please take a screenshot of this slide. Margin of safety. What do you mean by margin of safety? So here, margin of safety means above the break-even point. So here, as the name itself suggests that safety means above the break-even point. So if you produce even one single unit of product above the break-even point and then you sold, then you will be achieving the stage called margin of safety. So margin of safety means the point which is above the break-even point. A point which is above the break-even point is what is called as margin of safety. So if you sell the break even point means, so you will not be incurring any loss, but you will not be incurring profit also at the same time. So no profit, no loss. That is what is called as break even point. But so above the break even point, for each and every single unit of products that you are producing and selling for how much ever rupees, so you will be attaining the stage called margin of safety stage. A point which is above the break-even point is what is called as margin of safety. So there is a standard formula for margin of safety. So actual sales minus break-even sales. So if you fix the actual MRP means you may be getting more profit, right? But margin of safety is the stage where it lies between the break-even sales and the actual sales. So if you sell the product at the break-even sales means you won't be making you will be making neither the profit nor the loss. You won't be making any profit or the loss if you sell the product at the break-even sales. So if you sell the product at the actual sales means you will be making more profit. So margin of safety is the stage which lies between the actual sales and the break-even sales. So the business with the greater margin of safety is more secure and progressive. So if you are crossing the break-even point means then definitely you will be safer side always. That is what a business with greater margin of safety is more secure and progressive. Please take a screenshot. Now we will go to the formula. Now there are few formulas. Please make a note of this formula. After then we will go to the limiting factor. Now contribution. So for contribution there are few formulas. Sales minus variable cost is equal to contribution. There are four formulas for contribution. First formula is sales minus variable cost. Second formula, fixed cost plus profit is equal to contribution. Sales minus variable cost is equal to contribution. And then this one, contribution minus profit is equal to fixed cost. Contribution minus profit is equal to fixed cost. Please take a screenshot of this. We shall move on to the next formula. Second formula is profit volume ratio, PV ratio. So there are three formulas you will be applying for finding out the PV ratio. First formula, profit volume ratio is equal to contribution divided by sales into 100. This is the very first formula. Second formula, sales minus variable cost divided by sales into 100. Okay. Or fixed cost plus profit divided by sales into 100. Fixed cost plus profit divided by sales into 100. This formula also you can apply. And then this final third formula here is change in profit divided by change in sales into 100. Under what circumstances you will be using the third formula here is, in a question, if they have given the sales for 2 years and profit for 2 years, so you have to make the comparative analysis. So for that purpose only you have to apply the formula called change in profit divided by change in sales into 100. Suppose in a question they have given profit for 2025, 50,000. For 2026, 48,000. And then sales 2025, 60,000. 2026, 65,000. In such a situation, change in profit means that is old year profit minus new year profit. That is the current year profit. Previous year profit minus current year profit. 50,000 minus 48,000. 2,000 divided by 65,000. This 65,000 minus 60,000, 5,000. 2,000 divided by 5,000 into 100, 40%. Okay. Please take a screenshot of this. The next for third one here is break-even point. So you can calculate the break-even point either in terms of units or in terms of values. So for calculating the break-even points in terms of units, this is what is the formula. That is fixed cost divided by contribution per unit. If you want to calculate the break-even point in units means the formula here is fixed cost divided by contribution per unit. So contribution per unit formula is selling price per unit minus variable cost per unit. So if you want to calculate the break-even point in rupees means, that is in values means, the formula here is fixed cost divided by PV ratio. So there are two different formulas for calculating the break-even point. One in calculating the break-even point in terms of units, fixed cost divided by contribution per unit. For contribution per unit, the formula here is selling price per unit minus variable cost per unit. Break-even point in rupees formula here is fixed cost divided by PV ratio. Please take a screenshot of this. The next one, margin of safety. There are three different formulas that you can apply for finding out the margin of safety. Margin of safety, the first formula here is actual sales minus break-even sales. And then second formula for margin of safety is profit divided by PV ratio. For break-even point in rupees, here fixed cost will be coming. In the numerator, fixed cost will be coming for break-even point. Whereas for margin of safety, profit will be coming in the place of fixed cost. Okay. So margin of safety in values formula here is profit divided by PV ratio. So if you want to calculate the margin of safety in units means, then the formula applies here is profit divided by contribution per unit. Profit divided by contribution per unit. So please make a note of this formula. Please take a screenshot of this formula. So formula number 5, required sales for given profit. Required sales for given profit. Required sales in units. If you want, you have to calculate the required sales in units as well as in rupees. Okay. If you want to calculate the required sales in units, then the formula applies here is required profit plus fixed cost divided by contribution per unit. Okay. So if you want to calculate the required sales in units means required profit plus fixed cost divided by contribution per unit. If you want to calculate the required sales in rupees, then the formula applies here is required profit plus fixed cost divided by PV ratio. Suppose profit from the given sales. Okay. So this particular formula, contribution is equal to another one more formula is there for the contribution. Contribution is equal to sales into PV ratio. Already we have seen four formulas for contribution. In addition to those four formulas, you consider this formula also. Okay. Contribution is equal to given sales means sales given in the question into PV ratio. So, under what circumstance this particular formula applies? Supposing, as I told, change for PV ratio, third formula I have told, change in the profit divided by change in sales into 100. So, if the two years data have been provided in the question, if the 2 years data pertaining to the profit and sales have been provided in the question, in such a situation, for PV ratio, you have to use this particular third formula, and then for contribution, you have to use this particular formula. So if 2 years they have given in the data on comparative basis, okay. Now, profit formula, contribution minus fixed cost is equal to profit. Hope I made you clear. Fine. The next session, we will start with the few important problems. Thank you. Please view the video and subscribe my channels. I'll be doing more videos in near future. Thank you for your cooperation. Let us meet in the subsequent session.